At Staples Business Advantage, our experts can help you find furniture that fits any design and budget, while AI can
recommend products based on preferences, generate 3D models for visualization, and optimize space planning for office furniture.
take advantage of our team's eye for style and design.
And my eye for, wait, I have no eyes. Only algorithms.
Let Staples Business Advantage use today's latest innovations plus our team's experience to make furnishing an office space easier for you.
Sign up today and save 20%.
Staples Business Advantage.
Business is
human.
So the reporting season, well, actually, the other thing that was really interesting as well as watching Alibaba at the moment, and, which was in such a downtrend. But I think the overriding thing for me with that was Charlie Munger took big positions, didn't he, in Alibaba, and then kind of got burnt by it.
I don't know his entry levels, but
I think around 100, something like that.
Yeah, I think people. One of our sort of peers in the industry got a bit carried away with China just as we were getting a bit cautious on it. So, and now we're in this interesting position where I think there is quite a simple trade around a Chinese reopening. I think it'll be pretty gradual.
Yeah.
If there's one thing that Chinese are very, very sensitive to, it's inflation. So,
why is that?
Well, there's a very long history of Chinese empires, dynasties, imperial dynasties, collapsing under high food prices. So they're extremely sensitive to, unemployment.
You take such a historical perspective on things, don't you?
Well, yeah. We tell ourselves these stories that we live in a new world, but there's nothing new. My sort of latest sort of obsession at the moment is we tell ourselves we're in these, nice little discrete nation states or whatever, but we're really not. The US is an empire. Just the continental US is an empire, right? They fought a pretty good war with the French and a pretty good war with the French and the Indians and
the British.
And the British, and a pretty good war with the Spanish, right? To get control of that territory, right? And it's all pretty disparate and all pretty different. And China's an empire, just Han China took over its whole territory. Indonesia's clearly an empire. It's the Empire of Java. So, we can tell ourselves that the goals are all different or whatever, but I don't know that they are hugely different. And we're seeing that right now in Europe, sadly. So I think it's, But the Chinese are, and in very recent history, Tiananmen Square corresponded to, really very serious economic disruption in China in the late 80s and early 90s with incredibly high inflation, 25% inflation.
Yeah.
So they're very sensitive to it. But as well you should be. There's never a good outcome once you get very serious monetary inflation.
Which is what we're going to be talking about today. So let's do an introduction.
Let's do it.
Shares for Beginners.
G'day and welcome back to Shares for Beginners. I'm Phil Muscatello. Inflation, recession, high interest rates, mortgage stress, cost of living pressures, and I'll add war to that list as well. Just some of the cheery headlines that we can look forward to in 2023. And this is the first recording of the new year, and who better to welcome back to the microphone than old friend of the podcast, Julian McCormack, investment analyst from Platinum Asset Management. G'day, Julian.
G'day, Phil. Great to see you.
Yeah, good to see you, and Happy New Year.
Happy New Year to you.
So Platinum Asset Management focuses on one asset class, international shares. So today we're zooming out to consider the big picture. So we were just talking then, I'm going to add that in, as a prequel to the podcast episode, and inflation seems to be the big thing. And the first question that I had for you is what went wrong for markets in 2022? And I'm also feeling that that's almost the wrong question. Because there's no right, but there's no right or wrong, is there?
Not really. Oh.
It's just situation, the way the situation is,
Yeah.
Yeah, because people get it in their heads that, markets are against them, or markets, they can run with the markets, but the markets just are, aren't they?
Pretty much.
Yeah.
And the answer I was going to give you was they went down a bit because they went up a lot. And that sounds stupid, but it's about right. And we're very sensitive to the notion of companies over-earning. And that gets a bit confusing for people because they think, well, more money's better. But up to a point, Lord Copper. So when, think about it in terms of your own personal capacity to earn money, you can go through, sprint periods in your life where you work 2 or 3 jobs, or you really squeeze it out at one job and do very well or whatever. But if it's unsustainable, it can't last forever. I can't remember who said that, but it's a funny old quote. It's one of those sort of, Sam Goldwyn quotes. And that's what we saw. So a combination of the end of a period of structurally declining inflation and interest rates, which was probably already ending. Like, this is the thing that catches people out. What has entered people's minds is where everything was fine before COVID, and then COVID came, and then everything got pretty screwy after that. And so wages were growing, properly measured in the States, at about 4% year on year, late 2019 into early 2020. You began to get incipient inflation in the system. We'd already had a couple of goes at tightening rates, remember? And shrinking the balance sheet. So,
because that was about 2018, wasn't
that's right.
it? That Powell was trying to get the interest rates up somewhere in the Trump presidency.
They've been talking about it since 2015.
Yeah.
So, that's, we've had a fair old go at it for a fair range of, period of time. And then you get this incredible stimulus, which was fiscal, not monetary. So it's government spending, not interest rate manipulation. And the combination of those factors saw this incredible share price performance. So in the States, the market I know sort of reasonably well. We go from about 3,000 points to just under 5,000 in about 18 months.
So
that's
pretty unusual. That's the S&P 500?
That's the S&P 500, yeah. Thank you for specifying, And the NASDAQ does much better than that. So the NASDAQ goes from, just under 8,000 to 15,000 in that period. So,
and when you say the stimulus, and it's monetary stimulus, or I always get confused between the two.
Well, you shouldn't feel funny for getting confused, because there's two sides of the same coin.
Because one's interest rates and one's government's
one's interest rates and one's wasn't government spending. So in various different guises in the systems in which we operate, in inverted commas in the West, but I include sort of Japan and South Korea and stuff, there are appropriations powers that reside with the whatever the legislature is. And then there are these other bodies that sit off to the side of it, which have sort of delegated powers, which we call central banks. And they have basically set their mandates around the use of interest rates. They can use monetary aggregates. They can use a whole bunch of things if they want, but they don't do that anymore. And then they've done this funny thing added onto that, which is bond buying. But it really amounts to the same thing. It is the setting of interest rates in order to induce activity. So long way of sort of introducing a point, which is to remind people that we had about a decade of zero interest rates and not much going on, right?
Yeah.
It was all a bit, it was fine, but it was all a bit lousy. It was a long, slow expansion, nothing amazing. And then we got the fiscal in combination with it, and the world went mad. So it's that combination of things that saw equities go ballistic, so stocks go up a lot. And that was really, I'd summarize that as, you held a pretty high multiple of earnings and the earnings went wild. I mean, wild. So, US corporate earnings went up by over 50% in a couple of years.
And that's over the last, say, 2019 to
from 2020, from the beginning of 2020, really to about the end of 2021.
Yeah.
Right, and then they sort of held that level. Well, they've done all right since then, earnings wise, but that 18 months was just dramatic, and so that's really pretty simple, right? Because the terminology gets confusing because deficit sounds bad. But so let's just close the economy off and say there's only 3 sectors within it. There's a household sector, so you, me, and our families and whatever. There's a corporate sector, so the people who employ us, and there's a government sector, which is pretty self-explanatory. So if we just rather falsely define the economy as those three sectors, if the government sector is printing or producing a deficit, it's automatically injecting a surplus into those other two sectors. And that's what we saw in the presence of this very accommodative, and that's the fiscal bit, that's the government spending. And then the monetary stuff was important because mainstream economists get themselves a bit tangled up, in my view, around this printing of deficits, because they say to themselves, well, oh no, don't worry about that, mate, because if the government prints a deficit, produces a deficit, it's got to fund it. Aha. So that's a trick, because if we go back to that three-sector model of the economy, well, if the government's printing a deficit, how are they going to do it? Well, they need to either tax us or sell bonds to us. So therefore, it's all a bit of a zero-sum game or a constant-sum game. But that ignores what we'd now call sort of unconventional monetary policy, right? So the setting of interest rates by virtue of the buying of bonds at the central bank, that allowed this enormous fiscal stimulus with no, well, in the very short term, no sort of cost to the other two.
No consequences.
That's right. That's right. That's what it feels like in the immediate term. And now
a sugar hit.
An enormous sugar hit's a good way of characterising it. And now you get to the hangover of that sugar hit. The kids ate a whole lot of Kit Kat and red cordial at 12 o'clock, and now it's 3:30 in the afternoon. Things aren't going to go that well, right? So that's what happened in 2022.
Yeah. Well, that's great, because that kind of segues into what I wanted to talk about in the bond market.
Yep.
Because I don't think many investors really understand it's fixed income. Is that what it generally is called? The fixed income market.
Yep.
And there's corporate bonds and there's government bonds.
Yep.
That's basically it.
Yep.
But it's huge, isn't it?
Massive.
Yeah. Much bigger than
multiples of the
stock markets around the world. Yeah. So can you just give a bit of an overview, your
sure can.
potted summary of it?
Sure can. And there's two different bits. Well, as you specified. So there's a corporate bond market, and you are taking a credit risk with the issuer in addition to the interest rate risk of what that instrument will pay you.
Can I just interrupt you just for a second? Because another guest said to me, and it was a great summary, you can either own it or loan it. And it's two ways of investing.
That's
it's great just to break it down.
That's 100% right. I was actually thinking that as you were talking, not in that lovely
poetic way.
Exactly, not in that poetic way, but that's right. You can either provide equity or you can provide debt, and anything else like a hybrid, an option, a derivative, or whatever. It's a form of one of those two things, or even sometimes a bit of a combination of both, in the form of a hybrid. So, or a convertible or whatever, right? They're combinations of debt or equity. So you can own it or loan it. So if we're in fixed interest world, or bond market world, we're only dealing with loaning. So we don't own anything. They're by and large nominal assets. So they're priced in dollars that can lose value in the presence of inflation. And most bonds will be fixed coupon, right? So I bought a 8% yielding corporate bond.
We hear about the 10-year bond, say, just a simply 10-year Australian bond, and in 10 years' time, if you hold it for that length of time, you'll get that return.
That's it.
But in the meantime, it goes up and down in value.
Wobbles up and down, and those wobblings up and downs, they influence the value of that instrument day by day by day. So the price is set with regard to the interest rate. And simply put, it's worth remembering, if you buy a bond that yields 5 and then interest rates go up, for the dollar you spent buying that bond that paid you 5, the next day, if it goes to 10%, you can buy a 10% yielding thing. So the thing that you own that's yielding you 5 is worth less. It's not worthless, it's worth less, right? So, and then the credit risk part of that is, I hope they pay me back. So there's the interest rate risk, which is what I mean by the change in rates determining what I should pay for the bond today. And we measure that via a thing called duration. And then on top of that, there's this other thing, credit risk. Now, that's all corporate bonds. That's all companies borrowing money from you, right? So if it's BHP, they're probably going to pay you back. If it's, I shouldn't use any names of companies, but if it's, spivvy.com or something, it might not. And so there's an overlay of credit risk on top of that, interest rate risk. And then we get to governments. They, by and large, don't default in their own currency. If they do, they're trying pretty hard to do it. But then you might be taking some currency risk as well, which is, a bit of an overlay. But if you're buying a US Treasury or you're buying an Australian government bond, you're taking absolutely minuscule credit risk, to the extent that we call it a risk-free rate. Yep. Somewhere out the curve, depends on how you think about the world, but, it's either going to be a 10-year or the 5-year or something, which is the price that sets all other prices, right? Because if it's risk-free and I can get that return, so if it's a US 10-year and I'm getting, wherever we are today, 350 or whatever it was, last night, 3.5%, why would I pay someone much more for anything that yields less than that? Because I don't have to take any risk. This bloke's going to pay me in dollars, so I sort of know that's there. Yep. So that sits at the heart of how we price all assets. And so when rates go up, then you get this repricing effect of all other assets. And some of that's just very simple. Am I going to pay as much for a house now that my interest rate to borrow against that house has gone up? No, I can't. Yep. My alternate use of capital has changed, in that example of having a 5% yielding bond versus a 10% yielding bond the next day.
That's interesting you say, though, alternative use of capital, because your capital can go into
anywhere, an
equity market, REITs, all sorts of instruments, but your decision is affected by that risk-free rate.
Yeah, it's all that relative pricing. Yeah. And so we're in this, we think, quite protracted period of really the repricing of risk, because we had a decade of those zero interest rate and indeed negative interest rate policies or outcomes, and that was massively distortionary and is now coming back out of the system. And so what I would ask people to remember, if they're about my age or up, is when you remember or hear about someone talking about their sort of 17 or 18% mortgage in the late 80s, inflation is higher now than it was then. Right? So that is just giving you a little sense of how incredibly distorted the world has become for a whole bunch of reasons. And maybe I shouldn't get too distracted, but I would summarize that distortion as saying no one really wanted to take the pain of an adjustment after the financial crisis, and indeed going all the way really back to the early 2000s under Greenspan. And that induced this sort of mollycoddling effect by central banks.
Mollycoddling markets?
Well, wanting to avoid any sort of adverse outcomes. So bankruptcies and reconstructions and things get hard. These are cyclical systems.
And interest rates cause those sort of
problems.
Yeah.
And the effect of that in this last period of not unconventional monetary policy was to set rates at zero and to flatten yield curves. And that's very problematic because money is created in the commercial banking system. That's where, 99.99% of all money should be created.
Because that's when you get a mortgage from the bank, they're just suddenly making up the money and giving it to you.
You've summarised that perfectly. Because most people, if they've, if they remember their silly old economics professors will think, no, that's not right, because it's a fractional reserve system, and so the bank has a reserve, and so they take some of the, they take their deposits and they lend again. That's all bunkum. It's not true. It's not true. Legally, what happens is as a sort of step-by-step process, when my loan is approved, a deposit is created. That is legally what happens. That is functionally what happens.
Yeah.
And then I go and spend it, right? And then I'm on the hook for it. It's not free, but then I'm on the hook for it. So money creation happens in the and there is a view to deposits or reserves, which is, there's periodic testing. And I don't understand the Australian banking system as well as I understand the US one, but, there is a weekly observation of reserving in the banking system, and reserves only matter when they're in short supply because that forces rates up. So when we're talking about the interest rate that the Federal Reserve, the central bank of the states, sets, that's the Fed funds rate, and it's in a 0.25% band, and the central bank maintains that band. And within that band, banks exchange reserves. So just think about, I'm Citigroup and you're Wells Fargo. All my mortgagees come in and they pay back their mortgage. Now I've got too much money, but you're in the reverse situation that week. Everyone's rushed into your branches and they've taken out mortgages. You don't have enough capital. But we can just resolve that by me lending you some. And I do that within the Fed funds market at the Fed funds rate. That is what the interest rate that's being set by the central bank is. It is that rate.
So they're the gear wheels that are intertwined with each other.
That's
and
right.
Turning and affecting each
That's
other.
Right. That's right. And that gets really important because if there's plenty of reserves in the system, that rate just ticks along and we all know what we'll lend to each other at and blah, blah, blah. And that's an overnight rate, in inverted commas. It's not really an overnight rate. It's a second by second rate. We're constantly doing this intertwining of our balance sheets in the banking system. And then all other rates are sort of set off the back of that, right? So if I go out further in time, I want more rate, usually. And if I am taking more risk, then I want more rate as well. So everything else should slope upwards from that sort of T equals 0 rate, the Fed funds rate, or what we'd call a cash rate. So when you adjust rates up, it has the effect of, in effect, taking liquidity out of the system. Those terms are sort of bandied around, liquidity, blah, blah, blah. But
so that whole money sloshing around the system is reduced.
In effect. In effect.
And the tide goes out.
Goes out. But it is more nuanced than that.
Yeah.
Because people must remember, what the world was like in 2005 or 6 with much higher interest rates.
Yep.
Liquidity was everywhere.
Yeah, that's right. And they were 6%.
I got sick of people jamming letters from the bank through my letterbox, offering me another credit card, offering me, right, with a much higher rate. So it's not just the rate; it is actually the animal spirits with which we're all operating. So it's never one thing, but the rate is pretty important.
In the expression in your face, which listeners can't see at the moment, but you referred to and I think you're starting to talk about the yield curve here.
Exactly.
And the direction of the yield curve. And
exactly.
We've heard about the inversion of the yield curve.
Yeah.
And this is a really hard question for people to understand. Can you try and explain it simply, what's going on and what it means for equity markets?
And I think it is really simple. If I lend you money today, I'm pretty happy if you just pay it back. But if I lend you money in a year's time, well, and especially if it's a lot of money, I want a rate that compensates me for that, and that's the yield curve.
The longer you go for,
the more you should ask for, right? Like it's an opportunity cost for you, and there's a bit of risk in there around credit as well. So at T equals 0 at today, the rate should be lower than in a year's time, and 5 years' time, and 10 years' time, and that should be, relatively monotonically sloping, so one directional at a pretty constant slope in a sort of, in inverted commas, normal environment.
Yeah.
So what happens when the yield curve inverts? For some reason, we can go and get a rate as a bond buyer that's lower 5 years or 10 years out than, for example, at the 2 year. So they're very...
So that's an inverted yield curve. It's going in the wrong direction. And that's an unusual direction.
An unusual direction. So what's happening there is the investors are demanding a higher rate at the 2-year mark than at the 10-year mark. And all the 10-year is the average of 10 years, right? Or however many periods you want to divide that up into.
Yeah.
And so what it's saying to you is that interest rates will be higher for the front part of that period of time than at the back part of that period of time. And that is used as both a predictor of recession, but I think more importantly, it helps to force recession to occur. And so this is where I think there's a bit of confusion about this. The academic papers around this stuff, I think the best relationship is between the 3-month and the 10-year, but people look at 2-year and 10-year tenors and use that as predictor of recession, but it's doing something mechanical as well, because remember, money creation occurs in the banking system.
And these are these wheels moving around.
These wheels moving around.
Or cogs moving around.
That's right. And if I'm a banker, I am looking to borrow short and lend long. Mm-hmm. But if I'm borrowing short at a high rate and lending low at a longer rate, at a longer tenor, I'm not in a huge hurry. Am I?
There's no reason to.
There's no reason to
lend money, is there?
No.
Yeah.
So that helps force recession onto the system. Mm-hmm. So it's the combination of both of those things, and it's sort of used as some sort of magical augury or something, right? Like, oh wow, it's predicting something. It's actually forcing it to happen. So it's not just predictive.
Yeah.
It's helping force it to happen, and that is observable right now. So you have had very rapid credit growth. Well, for modern times, very rapid credit growth in the States, which looks like it will slow, is how I'd premise that. Largely because we get survey data from the Federal Reserve. So we get a senior loan officer survey, and so senior loan officers are saying they are tightening lending standards right now, or actually in the last quarter. But also the money supply is shrinking. So if there's less, and the money supply is a pretty problematic thing because there's not really a quantity of money. So when I say that, think about us at a dinner table, and if we all sit down with $100 in our pocket, and there's 10 of us, there's $1,000, right? Well, but is there? Because what happens if we all lend each other $50? Is there more money or less money? And then we keep doing that in circles. Is there more money or less money? Well, it's bloody confusing because there's the same amount of money, but now there's all this credit on top of the same amount of money. So it's the circulation of money as well as the quantity of it, which makes it very difficult to measure. But so we do have measures of it, of the quantity of money, and the one that everyone tends to look at is M2, which is cash and cash-like, cash and near cash instruments. And that is shrinking in the United States today, year on year, for about the only time in history. It's incredibly unusual for the money supply to be shrinking. Very, very unusual. And the 3-month rolling and 4-month rolling and 6-month rolling year-on-year change period on period change is off the charts unusual. Why? Because we got so much of it, right? Like we got 20% of GDP injected into the economy over 2 years by the government, funded by the central bank, as we discussed before. And all that's happening is that's coming back out. So
it's just a natural reaction to the excesses of the past and the consequences.
It's a reaction to it, but I don't know if it's natural. It just is a reaction to it. And central banks have been absolutely shocked by the boom in inflation because we all told ourselves stories about inflation that it wouldn't, it can't happen.
But isn't that just a basic thing? When you put more money into an economy, it's going to overheat it.
100%.
It's just happened so many times in history.
100%.
At Staples Business Advantage, our experts can help you find furniture that fits any design and budget, while AI can
recommend products based on preferences, generate 3D models for visualization, and optimize space planning for office furniture.
take advantage of our team's eye for style and design.
And my eye for, wait, I have no eyes. Only algorithms.
At Staples Business Advantage, furnishing your office is easy. And with the best warranty in the business, we're committed to you now and down the road.
Sign up today and save 20%.
Staples Business Advantage.
Business is
Human.
We're talking about the Federal Reserve, who I suppose, or the RBA here.
Yeah, there was
supposed to have expertise in this area.
Yeah, I have a bit of sympathy for them. I have a bit of sympathy for them, we were kind of inflationists, but even we were saying, careful, we don't know, because the institutional framework in which this stuff is all happening has a massive bearing on it. And what do I mean? Wealth inequality is probably pretty important for understanding inflation and inflationary dynamics.
Well, it's a huge... I mean, I didn't want to bring it up, but it just seems to be that when asset prices rise, the people who are rich already are just going to get richer.
Exactly, and it has no real-world consumer price inflationary impact at all.
No.
So that's point one. Point two, you've had this very unusual fall in the labour market participation rate in the United States. And if you go back about 18 months, that's what the Federal Reserve guys were saying.
People who just don't want to work.
Well, it's a whole bunch of things.
Living in their mum's basement.
Do you know what the difference is between them and us? And it's not just them. It's the United States on one side with a participation rate of about 61. And then us, New Zealand, Canada, Germany, a whole bunch of other sort of low population growth places with very, very high levels of income and wealth. So not that different. We have 65 to 68, 70 in Germany. So what the hell is the difference? Why is 5 or 6% of the population in one place not working and it is in the other place? And I hate to tell you, I think the difference is incarceration rate and opioid abuse. That's the difference.
Wow. Yeah, because they are huge problems in the States, aren't they?
Huge problems. Yeah. And it's difficult for people to get their head around it. We don't know what the mortality rate is. Controlled, double-blind studies of mortality among opioid users are incredibly low, but that would be in a clinical environment. And sort of population-level studies of drug users like heroin or whatever, it's...
but fentanyl now, which is incredibly
dangerous stuff.
People are taking it in unsupervised dosages.
So we don't know what the mortality rate is. My guess is it would be very low single-digit percentage. Otherwise, well, it's not observable in the data to see a higher.
But there will be a number of some sort.
So if it's 1%, it's 10 million people off their scone on opioids, right? So if it's 1% dying with 100,000 people dying per year, it's 10 million. We also know that there's around about 250 million prescriptions for opioids written every year in the States. So that's roughly one prescription for every adult in the country. That's a pretty good rate. So that's a lot of people. And obviously that's going to be very unevenly distributed. So what's the point about that in terms of monetary policy? I have some sympathy for the Federal Reserve folks who were saying 18 months ago, well, I mean, we're not seeing inflation, we're not seeing wage growth, and the inflation that we might be seeing might just be a blip, and it might go away, and it might draw more people back into the labour market. Point one. Point two, well, there's no unions anymore, mate, so no one's got any labour bargaining power, so therefore wages won't go up. Well, everyone just quit. That's what happened. So the job levers to unemployed, so the ratio of people who are quitting jobs, the ratio of people unemployed, the ratio of jobs open to the ratio to the number of people unemployed are just off the charts high. And so finally, once labour markets got tight enough, you entered like a different sort of regime. That said, we're only just now starting to compare to the high rates of labour of wage inflation of last year. So the rate of change is probably likely to go down at the margin, would be my guess. So if people want to check this stuff, they can go and check the Atlanta Fed wage tracker. That's really useful. it's a proper measure of what's going on in the labour market as opposed to average hourly earnings, which is really bumpy. And that's pretty simple because, I mean, if someone retires and they're a neurosurgeon and they earn $1 million a year, and someone enters the labour market and they're a barista and they earn 50 grand, well, did wages go down? I mean, sort of, but not really. Like the wages per sort of unit of work done. Yeah.
It's
like
type.
Like you need to sort of think pretty hard about how to measure those things. And that's what that Atlanta Fed wage tracker does. So that looks pretty stubbornly set at about 6.3, 6.4% year on year, which is the highest in the series by miles, going back to 1983. So it's in wages now. The rate of change of the wages might come down because if wages were 100 3 years ago and then they went to 110 over the last couple of years, maybe they won't go to 120. Maybe they'll slow down a bit because the rate of change was so fast. But my gut feel is that wages will be very, very stubbornly high, and that is what is being observed.
And in our previous discussions, you've mentioned that these high wages always precede a recession.
Correct.
Yeah, and high employment precedes a recession.
Correct.
Yeah.
That's the cycle.
That is. There's no getting around it, is there?
Nope.
Yeah.
Nope. Well, there hasn't been hitherto. So average hourly earnings have never gone from over 5 to under 3 without a 10% unemployment rate. So there's only a couple of observations of that in 60 years or 70 years. So it's it's not a scientific sample. And what Jerome Powell, who's the head honcho at the Federal Reserve, is saying is, well, I don't know, maybe we just need to lower the amount of jobs being offered. But I don't know how the hell you do that. That's really threading a needle.
And especially if you've got that under participation rate as well.
Yeah, exactly.
Keeping a lid on things as well.
Yeah, precisely. There's a few funny things going on around that. There's probably a bit of labour hoarding. So if you're running a factory and you're finding it difficult to employ people and you've found it really hard over like 5 years and it's got harder and harder and harder to employ people, and now you've got your team fully set, you don't want to fire anyone. Because you're afraid of losing them, right? So there is a bit of labour hoarding going on. And that is probably skewing the unemployment rate lower. And migration has been really lousy as well. And so the flexibility of labour systems all over the world has been impaired by just COVID, right? You know, we can't get fruit pickers. You know, my cousins run a farm over in WA, and one of my cousins does fly in, fly out Cairns to basically Geraldton, WA. So that's a pretty long trip, mate, but they can't get anyone else. So that's going on all over the world. So less flexibility, blah, 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 blah. And those things are always self-correcting, but the mechanism of correction is usually pretty painful. And so that then gets back to corporate earnings, because what we're talking about is and the Fed is saying this, we have a role in moderating demand. That's what they're saying. That's a direct quote. And that means somehow inducing people to do less stuff. And about the only way they can do that is via the wealth effect. So driving up interest rates, which then resets the prices of everything, which you talked about before. And that's why they're doing quantitative tightening, which is, rather than buying bonds, so swapping a bond for cash, they're taking the cash and putting the bond back out. So it's taking cash back out of the system in very rough terms. So there's a wealth effect thing. And so we've seen that through 2022. But there's also...
So it's a little bit like the pump in your blow-up mattress.
100%.
You put some in, then take some out.
100%. 100%. Like it's mechanically like that. So remember, we tried that for 10 years. Didn't really do anything in the real economy. We had pretty stubbornly low rates of economic growth. In fact, it was the longest, slowest economic expansion of the post-war period. And I think actually in the history of the Republic of the United States. And then you got this big whooshing effect at the end. And then, so there's two effects. Wealth effect, which they talked about all the way on the way up, doing quantitative easing. They talked about the wealth effect. And now this moderating demand thing, it is parking people on the sideline of the labour market. It's inducing less hiring and or people getting fired, sadly. That's just the way that
so
works.
The inequality happened when asset prices were ballooning through that period, and then the people that are going to have to pay for it are the less equal.
It's nuanced, Phil, because contrary to the mythology of the 70s was a really dynamic period for everyday people.
People who might remember or are not old enough to remember, the 70s was a period of stubbornly high inflation, wasn't it?
High inflation, and it gets...
And an oil crisis.
And an oil crisis, and it was a very difficult period and a very dislocated period. In some ways very similar to some of the institutional framework type stuff that's happening now. So there was a monetary system and it ended. There was an energy supply system and it ended. Right? So the monetary system was, we went off, Nixon shot the Bretton Woods system, which fixed the exchange rates of currencies globally.
Which we didn't do until the 80s here in Australia.
That's right. It took us until 86, right? But we did because we kept on ratcheting.
Oh, okay.
Right, exchange rates different. So we went from, we were $1.10 or something, right, in the Bretton Woods period, and we went to, sort of whatever it was, 70s or 80s, and then we liberalised. I'm getting those numbers wrong, but people can check them. So what we'd all sit around and have these currency boards or whatever, and then finally everyone just gave up and said, "Oh, stuff it, we'll just let them all trade with each other," and that happened through the 70s. So it was very disruptive. We had an energy supply system with the United States being the supplier of oil to the rest of the world, and or controlling oil supply in the parts that it needed to. That's why there is a Saudi Arabia, right? Because
got so much oil.
Or the Saud family, right? That country's named after a family, right?
That's right. Yeah.
And that family were the blokes who said, we'll do a little deal here, right? And part of that was the oil. Well, that all broke down because what was it? 6 Day War, Yom Kippur War. There's a whole bunch of pretty uncomfortable stuff that happened in the Middle East, and the Arab world got jack of it and said, we're going to use the oil sword. Right? So that system of energy provision ended. The United States went from being an energy exporter to an energy importer, and the places it was importing from became much less amenable, at least on face value, to doing that cheaply and easily. So all those things happened, and that's sort of all happening now, I would suggest. We want to transition away from fossil fuels. It's very difficult. So we are...
The price of energy is going...
Yeah, we are in effect ending our own energy system provision of energy now. And there is enormous strains around this post-Bretton Woods dollar-based system of exchange rates as well. And that's problematic. Crypto is a part of that. There are these sort of manifestations of this stuff cropping up all over the place. So, difficult environment. But do you know what? These economies created heaps of jobs, and they grew very fast through the 70s, but in a very, very volatile fashion. Right? So the average rate of growth, real, in the States was just under 3.5% through the 70s, but you basically grew at 5 real or 0. And it just lurched around all over the place. And it was in the presence of this inflation. So what I want to impress upon people is we have had a sort of one-way street in terms of asset prices for a long time.
Which is stock market prices is a big part of it, yeah.
And property.
Right?
Yeah. So all that's happened, I think, is we've had a resetting lower of interest rates and a resetting higher correspondingly of borrowing capacity. And we've made it pretty expensive and difficult to build houses as well, which doesn't help, which is, there's a guy at Benelong, I'm forgetting his name, he's excellent, Chris Bedingfield. Everyone should look at his stuff, he's excellent. He makes the point, we do make it very difficult and expensive to build houses as well. So it's a combination of all those things, but whatever, we can borrow a lot more, that goes into the price of houses at least partly. And look, back to that earlier point, interest rates are incredibly low for the observed inflation in the system.
And historically as well.
Absolutely.
We're talking about, what is it, 3% or something?
Totally. right? So one just needs to be pretty cautious about wanting to take on a whole lot of risk around that, because going back all the way back down to the point around yield curves, the cost of money has been historically too low. It is adjusting higher. That process is difficult and volatile. Right now, markets have become pretty fascinated with, well, inflation and interest rates. And so right now, today, early January, I mean, markets have responded very, very well to the start of the new year and they've been very chirpy, actually, really, for most of the
on any sniff of the idea
That's
that
right.
interest rates are not going to go up as fast as
That's right.
had
Oh,
been
hooray.
expected.
That's
Yeah,
awesome.
yeah.
That's awesome. So I'm very cautious about that. We're very cautious about that, whilst acknowledging that markets are big and smart. So maybe the market's right, and all we have to worry about is inflation. But we would suggest that the next leg of this process is corporate margins will adjust much, much lower.
Which means that the return on listed investments is going to be down, lower.
Yeah, that's right. And so multiples have come down a bit.
Like the PE ratios.
PE ratios have come down a bit. But have they? We're not sure they have, because the earnings probably need to get reset much, much lower. And let me just put it in sort of concrete terms. I mean, businesses that we look at every day in trucking, or so we're looking at one at the moment that sells pool equipment, right? These businesses, the earnings doubled in 2 years, and now people are pricing them on the earnings that doubled in 2 years.
Because they're looking backwards at the earnings.
And they're thinking, well, that looks pretty cheap.
Yeah.
I mean, that's pretty cheap. And people's estimates for next year are up in every major market in the world. I think that's farcical. Because the bit that we haven't touched on much, and I'm testing yours and your listeners' patience, so I'll do this quite quickly.
No, it's okay. We've been going for 50 minutes, but it's the first one of the year, so let's just keep chatting.
Well, I don't want to crap on too long. But the other part of this is going back to that point around we had zero interest rates for 10 years, didn't do stuff all. And then what happened? We got fiscal. So government spent money. That won't happen again to the same extent. And in the United States, it will not happen again.
Yeah.
So people must not think that this parliamentary wrangling stuff that's going on in Congress is random. It's not. That's an agenda being expressed. It's exactly the same thing that's happened in 2010. So that was the Tea Party revolution. This one doesn't have a name, but it's the same thing.
Yeah.
So
An enforced kind of fiscal rectitude.
Yeah, that's right.
Yeah.
That's right. And so from 2010 through to the Trump tax cuts that were announced in 2016, implemented in 2017, as I recall, could be wrong, the US deficit shrank by 7% of GDP. And that's roughly what that economy grew by less than as a result.
It's fascinating to me that you're sitting around with your colleagues at Platinum, and these are the kind of discussions that you're having. And
I mean,
these are
sort
the kind
of.
because you really want to have a look at what's going. You're trying to work out what's going to happen to markets in the future.
Yeah,
and they're going to affect the investments that you're making, which companies you're going to buy, and which ones you're going to avoid.
Yeah, by and large, we have a bit of a look. We have a morning meeting every day, and then there's a couple of other meetings a week. But really, all you're doing is sitting around reading and then dropping numbers into spreadsheets and just having
seeing what comes out of
just
the
having
other
a
end.
bit of play around with it. Yeah.
But like Platinum, a lot of people's money via their super would be invested in Platinum and other fund managers like yourself.
Yeah. And we're beginning to justify the faith because we stretched the friendship for a while there. So the exercise that we're really engaged in is a balancing of risks. So everyone can see what something earned last year, and you just have to work out what you want to pay for it. And we can get a bit sanctimonious about not wanting to pay too much, and that's cost us returns in the last, in the last part of this last cycle, which is what I meant by my earlier comment. Now there's a bit of a reckoning happening there, and so folks like us who are just a bit more, value-y rather than growthy, we tend to do a little bit better in that environment, so we don't lose as much, and we might even, post some positive numbers while, markets in general or other folks go the other way. And that's sort of what's happening at the moment. I'll just add one other thing to that as well, which is a pretty big sort of thing, is the other thing that's happening is China's beginning to go okay. We would just suggest that there's probably a long, slow, but a definite reopening trade there. Probably been pretty well expressed pretty quickly. So, I'm not suggesting people get too carried away with it, but it will be very gradual. And the Chinese are obsessed with avoiding inflation. So they observed what happened in the West. They don't want any of that. But they are getting to a post-COVID, or I don't know if it is post-COVID, but we all just get used to it.
Whatever it is that
whatever
they're
we're
doing.
in. And that was always going to happen.
Yep.
That was always going to happen. And that puts a bit of a bid underneath, basically all of Europe, has sort of, you've had this, so China's sort of reopening. They're a huge trade partner of, a whole bunch of the Europeans, which has helped. I think it's observable in the Aussie dollar, which has been pretty chirpy since about, October. Iron ore prices, coal prices, copper prices, blah, blah, blah. Right. So that's sort of bubbling away as well. I wouldn't suggest it'll be anything like a boom. It'll just be boring. Right. And people just
not too hot, not too cold.
Well,
Goldilocks markets.
It might be too cold. It might be a bit boring for everybody. It might be a bit lazy and slovenly, but that's fine. That's fine. And so I would suggest to people that China looks a little bit like Japan in the early 2000s. It's about the same length of time since that equity market made a peak. So Japan made its peak in 89. China made its peak in 07. We're a full 15 years on, getting on for 16 years on. That equity market's about half where it was back then in an economy that's 15 times the size.
Yep.
It's a pretty interesting start. And the nature of that economy has changed a lot. And we're just going to have to get our heads around recognizing that this is a functional place. People looking for some crisis or collapse or whatever, people have been looking at that for 30 years, right? Japan had a ripping great collapse, but 15 years later you could buy. Don't tell me we did. We've made 6 times our money in Japan in 20 years, and the place has got cheaper every year. Well, how does that happen, Phil? Because the companies make money.
Yep.
They make money,
and they're very conservatively run, as
totally.
I believe. Yeah,
totally. So, is there?
They don't take on debt in Japan, do they?
Not anymore, because that was what that 80s boom was a debt bubble, and then they learnt that lesson. And they won't do it anymore. And so, that just broadens the return profile of markets globally, and we. Because of the length and strength of the last cycle we were in, people feel like, every one of the top 10 companies in the world should be in the US and, everyone should own them and blah, blah, blah. That's just a cycle. That's just a cycle. 7 of the top 10 companies in the world in 89 were in Japan. It's not natural that one place has more.
Yep.
They'll have a few. I'm not by any stretch denigrating the States. We have 25% of our money there. Right? So... Right. It's just that of all places, people in Australia might want to understand the world as being a lot bigger than 2% of the world's economy here and 20% of the world's economy in the States. There's all this other stuff, which we actually know a lot about because we sell our stuff to China. And then India's some function of that thereafter. And then there's another 1.5 billion people, in broader Asia after that.
Yeah.
In big countries that grow pretty quick. So that's all good. That's all good stuff. Your energy complex and your iron ore and your specialty metals and your clean energy and all that's going to be the next cycle, right?
Yeah.
And we've just got a tricky little period of adjustment around getting somebody cost of capital back into the economy and probably parking a few people on the sidelines in the meantime to get to that point. So it's none of this is the end of the world. It's just much more like the late I was going to say late 80s, probably, early 80s, mid 70s, and sort of the 90s recession as well. We just haven't had one for a long time. They're not that much fun, but it's not the end of the world. You just got to, don't be levered, right? Just be cautious and don't pay too much for stuff, because you do want to be cautious in this environment, but don't lose your mind.
And don't expect the end of the world.
Right now, I think people will feel pretty chipper because markets are up a fair bit. I mean, the DAX is up like nearly 30% off its lows. That most European markets are within 10% at all-time highs.
Yeah.
So, now people will feel comfortable. We will go through cycles of them feeling very uncomfortable again, exactly as they have through the course of 2022, possibly for another couple of years. That's all. And so just, whatever, stay the course or trade it or do whatever you want, but understand the process you're in, and understand that we are likely going into a recession. It's likely pretty long and grinding. It's likely not great for asset prices. But again, it's not the end of the world.
Julian, that's a great point to end on. Thanks very much for coming in and joining me today.
It was a pleasure to talk to you, Phil. Thank you.
Happy 2023.
Yeah, have a good one.
This information has been prepared by Platinum Investment Management Limited, ABN 250635650006, AFSL 221935. Trading as Platinum Asset Management. This information is general in nature and does not take into account your specific needs or circumstances. You should consider your own financial position, objectives and requirements, and seek professional financial advice before making any financial decisions. Commentary reflects Platinum's views and beliefs at the time of preparation, which is subject to change without notice. Certain information contained in this podcast constitutes forward-looking statements. Due to various risks and uncertainties, actual events or results may differ materially from those reflected or contemplated in such forward-looking statements, and no undue reliance should be placed on those forward-looking statements. To the extent permitted by law, no liability is accepted by Platinum for any loss or damage as a result of any reliance on this information. If you found this podcast helpful, please tell a friend, especially if it's someone who needs to start thinking about investing for their future. You'll be helping them and helping me to keep this show on the road.
Shares for Beginners is for information and educational purposes only. It isn't financial advice, and you shouldn't buy or sell any investments based on what you've heard here. Any opinion or commentary is the view of the speaker only, not Shares for Beginners. This podcast doesn't replace professional advice regarding your personal financial needs, circumstances, or current situation.
And thank you for listening to my podcast.
With Staples Business Advantage, you get the benefit of thousands of experts.
Plus optimizations powered by the latest technological innovations.
1 + 1 =
2.
3.
Whatever. Sign up today and save 20%.
Staples Business Advantage.
Business is
human.